Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to discuss an email that I literally just received 5 minutes ago. And it asks such an important question that I thought I would tackle it in today's video. Here's the question. It comes from a viewer named Bill. He says, "Hey Rob, love your pragmatic approach to retirement finances." He says, "The bucket strategy is so widespread, but you have debunked it before in favor of a simple rebalancing strategy." Here's his question. "Do you have a system for rebalancing that negates sequence of returns risk?" That is a really good and important question, and we're going to look at it today. And to start with, what in the world is sequence of returns risk? And it's something, by the way, as you'll see in a moment, that I don't think Dave Ramsey has figured out yet or properly accounts for, as we'll see in just a minute. Although this really isn't about Dave. So sequence of returns risk, the idea is fairly straightforward. Imagine two retirees, they're both 65, planning for a 30-year retirement. And let's assume we know ahead of time that over each of their 30-years in retirement, they're going to average, we'll just say, 10% returns in their portfolio. Wouldn't that be nice? And we'll just assume that inflation averages 3%. You would think that both outcomes would be the same, right? But it turns out the answer is no, they won't be the same if the order in which those things happen, each year, what's the return going to be for their portfolio? It may average 10%, but we know it's not going to actually literally be 10% every year. Some years it might be 25%. Some years they might lose 20%. And the same is with inflation. Sometimes it might average 3%, but sometimes it could be much higher or perhaps even lower. And it turns out that sequence really matters, because we could take one of those retirees and say, hey, your first 10 years are going to be great. You're going to actually get returns greater than 10%. Inflation is going to be real low. And then things are going to get ugly. It'll average 10% returns and 3% inflation after 30 years. But that second half of your retirement is going to be really ugly. And for the other person, we could say, you're going to get your ugliness out right away. Your first 10 to 15 years are going to be really rough. And then come the good times. Does that matter? And it turns out, yeah, it matters big time. The person who experiences really bad market returns and high inflation, say in the first 10 to 15 years of, in this case, a 30-year retirement, will likely not do nearly as well. And in fact, they could run out of money long before the 30-year period is up. And let me show you that on the site. We're going to look at FI Calc. By the way, I have on my site, I've created a tools directory. I've mentioned it before. It's right here. You can go to tools and you can see the directory. The tool we're going to be using is FI Calc. And I have a page on it, and then you can go to the actual website, and here it is. So what I want to do to begin with, just to show you visually sequence of returns risk, we're going to assume $1 million portfolio. You recall I did a video with about Dave Ramsey's view. He says, hey, you should be 100% stocks. And because he says they average 12% return, you can take out 8%, leave 4% for inflation, and you should be fine. So we're going to withdraw $80,000 on a $1 million portfolio for a 30-year retirement. We're going to adjust the payouts for inflation. And you can see it actually, it doesn't do so well. It succeeds only 40% of the time. Yet we know, even if we might not agree with Dave's 12%, we know stocks long-term have done quite well in the United States. So why is that so low? And the answer is sequence of returns risk. We can actually come down here, and it walks through the different 30-year periods. We'll show them all. I think they go back to 1871. They do. And you can look at any of these. Actually, yeah, 1871. We're going to focus on 1966, and there's a reason for that, and we'll come back to it. But here's 1966. The X means you run out of money before the 30-year mark. If you get a green check mark, you didn't, and it also, if you can read that there, shows you your ending balance. So a lot of red checks, crosses, but some green, right? It just depended. And what did it depend on? Sequence of returns. Sequence not only of returns, but sequence of inflation. So again, if we go to 66, here's their portfolio value. They started in 66 with $1 million, and they were bust by January 1978. So much for Dave's 1 million, all stocks 8% withdrawal rate. If you happen to retire in a period of time like the mid to late 60s, things are not going to go so well for you. And you can see we were adjusting for inflation. And then, of course, we just ran out of money. That is a sort of a visual representation of sequence of returns risk. And we know, at least those that study a little bit of history, There were bad markets in the late 60s, and then 73 and 4 were terrible markets. And then, of course, inflation was starting to rise. And so it was a really bad sequence of returns risk period. So that's sequence of returns risk. Now, how do we address it? And the question from Bill was bucket strategy versus just rebalancing. We're going to talk about that. But before we do, we need to really talk about, I think, the primary way we deal with sequence of returns risk, and it has to do with our withdrawal strategy. That is how we decide how much money we can spend each year from our portfolio. Now, you're probably all familiar with the 4% rule from Bill Bingen's 1994 paper. You probably, maybe, don't think of that as a way to deal with sequence of returns risk, but that is exactly what it is, because what he did, we can go back to FI Calc for a minute, he looked at 30-year periods, and we'll go down to it. He started in 1926, so he looked at 30-year periods that began starting in 1926, right here, and went through 1976. And what he did for each one of those periods, he said, okay, we're going to take out a starting percentage. He did it from 1 to 8% with different stock bond allocations. And he said, which ones will we survive? Which ones will give us the green check mark, so to speak? And which ones will give us the red X? And we'll run out of money. And what he found was that if you start with 4% and with many other assumptions that he used, you never run out of money. Now, for many of those 30-year periods, you could have started with a much higher initial withdrawal rate, some as high as 8 or 9 or 10%. But if you wanted to be as safe as possible, start with 4%, and that survives every period that he looked at. Well, what he was effectively doing was dealing with sequence of returns risk. So one of the ways to deal with sequence of returns risk is to start with a very low initial withdrawal rate, assuming you're going to adjust your spending each year, as he did, by the rate of inflation. The 4% rule is one approach to dealing with sequence of returns risk. Now, we know it's not a guarantee. Looking at history, it worked. Will it work in the future? There's a lot of debate about that, and the reality is no one knows. But I'm going to assume at some point we're going to experience a 30-year period where it doesn't work. Now, what's that mean? Does it mean that 3.9% would have worked, or will it be a really bad period and much lower than that? Well, we don't know. But at least based on history, starting with a relatively low, safe withdrawal rate like 4% is a way to deal. We can't guarantee that it negates the sequence of returns risk, but it's a reasonable approach to dealing with it. Now, that's not the only way to deal with sequence of returns risk. We could do another approach would be what we've talked about in the past, and that's guardrails, where the idea is maybe you start with a higher initial withdrawal percentage, say 5%, and you adjust it each year for inflation. But what you do before you make the adjustment for inflation, okay, I got to take out this much money, but before you actually pull it out of your portfolio, you figure out what is the percentage of my portfolio that this new distribution is going to represent. And if it turns out that it's, say, more than 6%, then you'll cut back. You'll say, okay, that's too much. I'm in the danger zone of running out of money. So the amount I wanted to take out would have been whatever. Let's say it came out to 6.4%. I'm going to take a haircut and reduce it so it's only 6%. The flip side is maybe when you do the calculations, it's only 3.5%. And so you can actually increase the amount you spend if you want to, up to that bottom guardrail of 4%. Guyton Klinger, the two gentlemen that have published some research on this, were sort of the first that I know of to introduce this concept. Michael Kitzes has written a lot about it. But let me show you in FI Calc, we can actually do that here. We can do right here, Guyton Klinger strategy. And they describe it here a little differently than the 6% upper guardrail and 4% lower guardrail. They use, and this is from language from the Guyton Klinger paper, the capital preservation rule. In other words, this is going to kick in if things don't go so well for us. So if our withdrawal rates start to exceed 20% of our initial withdrawal, we're going to take a haircut by 10%. And then the prosperity rule, that's if things turn out better than we expected. It's just the opposite. If our withdrawal rate is below 20% of our initial withdrawal rate, we'll get an increase of 10%. And of course, you can change these numbers, but that's the idea. And so that's another way to deal with sequence of returns risk. The idea being if we end up retiring in a bad period, and we might not know that for 5 or 10 years, but if we end up retiring in a period, say, similar to 1966, we could use this guardrail approach. And the thing I'll point out, though, is if we go to spending, this is the thing we have to understand. Remember, the 4% rule is adjusted for inflation every year, so it's a straight line. It would be represented $40,000 if we had for $1 million portfolio, straight across. Here with guardrails, we can end up spending a lot less than the inflation adjusted amount. We started at 40 grand, but by 1983, 84, 85, we're only spending 20 grand a year. Now, when the 80s kick in and things start to do better, we go up, but that's the downside to dealing with sequence of returns risk with something like guardrails. Now, in this case, one could argue that we could actually increase our initial withdrawal to 50,000, 5%, and we could. And in fact, if we go back, we're still going to see it's a 100% success rate, but it's because we're taking really big haircuts if we have a bad sequence of returns, like we'll go back to 1966, and here we go again. And I'm intentionally picking a very bad sequence of returns risk, by the way, probably the worst in 100 years, maybe 150. But we started at 50,000 because we started with that 5%, and sure enough, we're still down to this 20 for a while, and we pick up, but not as much. And so that's just trade-offs, right? Higher initial withdrawal rate, but we have to be aware that if we happen to have retired in a very bad time period with really bad sequence of returns risk, on an inflation-adjusted basis, we could be spending less and less money for a period of time, maybe even a long period of time. Now, as I mentioned, Kitces talks about this in terms of percentages, maybe a 6% upper guardrail and a 4% bottom guardrail. Well, imagine that we put those together and we make them closer and closer and closer, and we just set them both at 5%, the upper and the lower. You say, well, Rob, that doesn't make any sense. Well, I guess not, maybe. But the point is, we could just do a percentage of portfolio. That's effectively what just a flat percentage of portfolio is. It's when the upper guardrail and the lower guardrail are the exact same thing. We can use 5% as an example. This would be another way to deal with sequence of returns risk. So can we model that in FI Calc? You bet. Just go to percentage of portfolio. We'll pick 5%. We're still sticking with 100% stocks, which probably is not the best approach, but for our purposes, it's fine. We've got 100% success rate, and that sounds good, and I suppose it is, but we have that success rate because with a flat percentage of portfolio, if the market goes down because we've got a bad sequence of returns when we happen to retire, our spending is going to go way down. And again, we'll just pick that bad 1966. I hate to pick on 1966, but it was rough. If we go to our spending, yeah, look at this. We started at that 50,000, but we're down to 20 grand. And that's only, by the way, because I set the minimum annual withdrawal at 20. If we get rid of that, we actually go down a little further, 19,000. This is 18,690. So there are trade-offs with dealing with sequence of returns risk. Now, before we get to the bucket strategy versus rebalancing, one last thing to think about is you could say, okay, Rob, I kind of like the inflation adjustments, Bill Bengen and the 4% rule, because the spending doesn't fluctuate so much. But on the other hand, I kind of like the higher initial withdrawal rate that maybe the guardrail approach gives us. How do we combine them? Well, there's always trade-offs, but you could do what a lot of endowments do. This is called the Yale endowment approach. And what you do is you say you use both approaches. You use both not the guardrail typically, but the percentage of portfolio approach and the Bill Bengen adjust for inflation approach. So you might take 30 or 40% of your spending each year and adjust that amount for inflation. Perhaps that could be an amount equal to what you consider your necessary expenses. And then for your wants, not your needs, but your wants, whatever percentage that is overall, you could just use that portion and just take a percentage of your portfolio. So for your required expenses, they're getting adjusted each year by inflation. Doesn't matter what the market's doing. And for your wants, your nice to haves, that's coming out as a percentage of your portfolio. It could go up in good years, but it's going to go down in bad years. And I can't honestly remember. Let's see if, they do actually do this in FI Calc. I'd kind of forgotten. The endowment strategy. And that's, I won't go through it, but that's effectively what it does here. So you could play with the FI Calc tool to take that approach. So having said all of that, where does the bucket strategy fit in versus rebalancing? And the truth is, these are important parts of dealing with sequence of returns risk, but frankly, they're not the most important. It's our spending policy, how we're going to take money out, that really drives either an increase in the sequence of returns risk, and some of you may be willing to take that risk, or a decrease in that risk. But still, rebalancing versus bucket strategies, they do matter a lot. So we're going to actually go to the whiteboard today for this one. Here we go. So let's think about a bucket strategy. There are different ways to implement the bucket strategy, but probably the most important is 3 buckets. So you would have a cash bucket. You'd have, I'll call it bonds, but it's usually safe sort of fixed income investments. And then you'd have stocks. And the idea behind these is that rather than filling these up based on a percentage, like you normally do with sort of an asset allocation approach, you'll do it based on years of expenses. So just to keep the math easy, let's assume we've got $1 million and we're going to put 3 years in cash. So that'd be 150,000. And we'll put, we'll say 7 years in bonds. So that's 350. And then you just dump the rest, in this case, 500,000. If I've done 354, yeah, 500,000 in stocks. And that's the bucket strategy. And so what would this look like, say, after the first year? Well, we'll assume we spent 50 grand in cash. So we're down to 100,000, right? Let's assume for the moment the bonds are just flat, 350. Now stocks, of course, let's say if they're down 20%, you'd have 400K. Of course, if they're up 20%, you'd have 600K. But the idea behind the bucket strategy is this. Let's assume it's a really bad year. That's what we're worried about, right? Sequence of returns risk. So let's say this is down to 400 grand. What the folks that use the bucket strategy would say is, look, this is great for dealing with sequence of returns risk, because what we're going to do, we want to fill up the cash bucket. Normally what we would do, you could think about it as, normally we would take 50,000 from the bond and put it here. That would bring it up to 150. And then we'd take the 50,000 from stocks to fill up the bond so that it has 7 years. Of course, you could say, well, Rob, why do all that? Why couldn't we just take 50,000 from stocks and put it in cash? Yeah, that's what you would do. You wouldn't need to do it in 2 steps. You could effectively just do it in 1. But in this case, what the bucket strategy folks would say is, no, we're going to leave stocks alone because they had a bad year. So what we'll do is we'll take 50,000 from our bonds and move it over here. So that gives us back up to 150. And we're down to 300 in bonds. That's only roughly 6 years of spending, but that's okay. And we could even do this for 2 years, 3 years. We've got 7 years in bonds. So it's a big cushion. That's the theory behind the bucket strategy. Of course, if you're going to implement that, you have to start thinking, well, when do I reverse that? Do I take from stocks in the first year that they just happen to be up? Or do I have to wait until they get back up to their point where they had started to go down? Who knows how many years that could take? And there's another problem with the bucket strategy. When an asset, when the asset class goes down like it did here, yeah, we don't want to sell it, but actually, don't we want to buy it? Isn't that what we want to do, is actually buy it? Now, what some would say is, well, Rob, there's nothing in the bucket strategy that says you can't go from bonds to stocks. But how would you do that? Because the rules we have are 3 years in cash, 7 years in bonds, and then the rest goes in stocks. So how would we even think about that? And so you can imagine with the bucket strategy, we have to have all these decision rules in place as to when we're going to not take from stocks and leave them alone, and for how long, or perhaps we're going to reverse the flow and maybe put money in the stock bucket. It's complicated. We can still think of the buckets, if that makes us comfortable, without using years worth of expenses other than perhaps for cash, right? So for example, if we go back up here to the initial allocation, we could say, fine, we're going to leave 3 years for cash. But for bonds, we're going to think of this not as 7 years of expenses, but just 35%, which is what 350 divided by $1 million is. And stocks will be 50%. That's all. And we can have 3 years in cash. That's fine. And so if we rebalance every year, when we want to fill up the cash, it doesn't matter which one we take from, stocks or bonds, because we're going to rebalance them back into the 50-35% anyway. And so we could just leave it at that. So for example, if after the first year, we have 400,000 here, still 350 in bonds, and we're down to 100,000 in cash. What is that? 4.7, that's $850,000, right? And we know half of that is 425, which if we're going to do 50% in stocks, that's what we need in stocks. We have 400. So what are we going to be doing? We're going to be buying. In this case, we're going to put 50,000 from the bonds over into cash and 25,000 here. Now, I probably wouldn't think of the cash as part of my allocation. I would actually just do percentages based on just the stocks and bonds because I think it's easier. But the point is, in this case, using just your traditional rebalancing and percentages, you're going to end up buying more stocks. And that's exactly what you want to do because in this hypothetical sequence of returns risk and all, stocks had gone down. So I actually think the traditional sort of percentages and rebalancing protects us more from sequence of returns risk than a traditional 3-bucket strategy because first of all, it's much, much easier to implement than coming up with all these decision rules about how you're going to move money one way or the other from one bucket to the next. But it also causes us to buy low, right? When stocks are down, we're going to add to it as we rebalance. And if stocks are up and bonds are down, we're going to add to the bonds just as part of the natural annual rebalancing. Now, it turns out I'm not the only one that thinks this. If we go over here, and I'll leave a link to this below the video. This is 2014. This is 10 years old. Michael Kitces had figured this out a decade ago. Managing sequence of returns risk with bucket strategies versus a total return balancing approach. And he summarizes it nicely here. He says, yet when such a decision rule strategy, meaning all those rules we need to manage a bucket strategy approach, is paired with simple rebalancing, it turns out that the outcome is no better than merely managing the portfolio on a total return basis without the decision rules at all. And he says the key, as it turns out, is that rebalancing done alone already has an astonishingly powerful effect to help avoid unfavorable liquidations as the process systematically ensures that the investments that are up are sold and the ones that are down are actually bought instead. So that's my take to Bill's question. Now, I want to stress there is nothing that we can do that eliminates sequence of returns risk. I suppose you could say, well, we could just buy all tips and a tips ladder, or maybe we could just annuitize our entire portfolio. Yeah, those are theoretical options. They present their own issues, which I'm not going to get into in today's video. But the point is, we can't eliminate the sequence of returns risk. We can mitigate it. I've talked about the various withdrawal strategies at a high level and how they affect and try to deal with sequence of returns risk. And then when it comes to the bucket strategy versus just simple percentage allocations with annual rebalancing, I've sort of demonstrated at least my view as to why the bucket strategy, I think, fails us. I like the bucket strategy for those that say, I want a year's worth of cash in a bucket by itself. I get that. It makes a lot of sense. And by the way, the creator of the bucket strategy, Harold Ivinsky, who was on the show last year, that's exactly the bucket strategy he designed. He's never actually used a 3-bucket strategy. Other people came up with that. His bucket strategy was just a separate bucket for cash and then a percentage allocation of of stocks and bonds in the second bucket, and that was it. That to me makes a lot of sense. But Bill, the 3-bucket strategy, it's a pain to implement. I think it makes things harder, and at the end of the day, I think you actually get better results if you're just using sort of the traditional percentage-based rebalancing every year. There you go. That's my take on it. If you have any questions or comments, leave them below the video. And until next time, remember, the best thing money can buy is financial freedom.